in reality, if you're cynical, it may be the fact that every single person in Congress and president and wealthy people all use this tool. Insurance is such a powerful asset that wealthy people were pouring money into it, so much so that Congress was lobbied by financial services firms to restrict how much money can go into it because it's that powerful, and they were losing market share. Now, as far as financial tools go, whole life insurance is a cheat code. All right, hey, welcome back to Remnant Finance. This is another solo episode. I'm going to jump right into it. Last time we did what our producer called IBC Masterclass. There was a 1 hour overview of a process that I like to walk through with new clients to teach them what cash value is, what base and PUA premium are, how they relate, how they do different things as far as what we're trying to do, how they contribute to purchasing death benefit in different amounts by different, effectively a different structure, and cash value. And it's basically they're just trading off different factors. The base premium, we're putting in force a relatively large amount of death benefit right off the bat, but it's paid down over a long time frame. Conversely, the PUA is putting in force a small amount of death benefit, but it's fully paid for now. And so when we talked about last week, the factors that change what the net present value of a future death benefit is, or a future payout, and I use the example of the mouse here to talk about a promise to pay. If there's a future value at a set point in time in the future, and then it has a present value today, and the amount of time till maturity and the amount of future obligations will both affect what that is worth today. And so go back and watch that if you haven't, because I think that was a pretty good, hopefully a pretty good overview to help you understand some of these factors. But after watching that, you might be saying, if you're of the mindset that you want to get as much cash value now as early as possible in order to take out a policy loan, go use your policy, etc. You can watch some of our episodes on policy loans. Most recently with Joe Withrow on a live webinar we did with the Phoenician League audience, we talked through, I actually pulled up the whiteboard and drew through what we use a policy loan, how we use a policy loan mechanically, what we're doing there. And I might hit that again today, but I want to cover a few additional things here. This is kind of, typically this call would be like part 2 of what I'm going to walk through with a client. Today I want to answer the question, if all you care about is cash value now. Let's say I've got a client, single, doesn't have children, doesn't, the death benefit is not important to them. Sure, there's a family member that might they want to benefit, they leave something to a charity or something, but as far as why they're on my calendar, it's not for death benefit. It's for living benefits, it's for cash value now. Why wouldn't they just put 99% of their premium into PUA? Why wouldn't they just put 100% of their premium into PUA? Why can't we just do a single pay premium policy? And that gets into the Modified Endowment Contract rule. We're going to talk about what that is, MEC, Modified Endowment Contract, or the MEC. We're going to talk through a little bit of history there. I'm going to pull up the whiteboard again and give a visual of why exactly we can't just structure that policy that way, why we are kind of handicapped in how aggressive we can be with these policies, considerations that we need to make that Brian and I or your agent make when crafting these policies. And then I also want to get into an actual illustration and kind of walk through what we're looking at and put some of the meat on the bone here and put these concepts together in a way where you can see the numbers play out over time. So we kind of talked about it conceptually, but let's see an actual illustration here. Okay, so a little bit of a history on the Modified Endowment Contract. Brian and I want to do a full episode on this where we dive deeper, so I'll kind of summarize a little bit here. But effectively what happened in the 80s, they changed the depreciation benefits of real estate, i.e. the taxation of real estate became a little less favorable. So a lot of wealthy investors said to their CPAs, how do we find the same tax benefits? And their CPA said, get a single premium whole life policy. Put a big chunk of money into a policy one time, throw $1 million, $500,000 into a policy. You put in force a large death benefit, so you increase your estate tax-free, right? You're gonna value your beneficiaries. Now, tax-free on the beneficiary, where if we get into estate taxes, there's more to it. That adds to your estate if it's in your name, not the scope of today. So if someone's listening that's well-versed in estate planning, tax-free to the beneficiaries, not talking about estate tax here. But they say, buy this large death benefit with one single premium payment. You never have to pay a dime into it again. And now you get this guaranteed growth, right? Going back to last week, That cash value is available in full today. You put $500,000 in, you got $500,000 in a savings account effectively is how you can look at it, right? You have this cash value that's going to grow and mature and materialize into the death benefit one day, which will pass tax-free to your heirs. And in the meantime, you have all of the benefits we talk about. You have the policy loans. You're going to earn dividends. You're going to continue to grow that death benefit by purchasing PUA with your dividends, all the stuff we talked about last week. And so money pours into whole life insurance. And because it's such a valuable tax play, CPAs are saying, go put your money into whole life insurance because the tax benefits are so enormous here. Money floods in, right? And whole life insurance is not a tax loophole. It predates the tax code by 100 years. It's just the power of having a tax-free death benefit to your heirs is something that has been long recognized by the government. We're not going to tax people when they leave money and do the responsible thing to the next generation because we don't want the burden of taking care of every generation. Now, those of us who distrust the government and their intentions, that who knows the veracity of that. In reality, if you're cynical, it may be the fact that every single person in Congress and president ever, and wealthy people all use this tool, and so that might more be the reason why they're not going to tax these death benefits. And because that death benefit is not taxed, whether you believe it's because they're all doing this is a strategy that those people all have, or whether you believe the altruistic version, which is the kind of the textbook version of the government can't take care of everyone, and so you do this responsible thing, leave money for those you leave behind, and we're not going to tax that. Whichever it is, either way, regardless, the death benefit is tax-free, and therefore the cash value, the net present value today is tax-free, and the growth of it is tax-free, and the access of it is tax-free, i.e. policy loans. Or if you take those dividends, you could take them as cash, as tax-free income up to your cost basis, i.e. once you've taken out more in dividends and tax-free checks effectively than you've put into the policy, then it becomes taxable. But until then, it's not. And so we have this incredible tax benefit in the IRS code, section 7702, that defines what a life insurance contract is and gives us all these wonderful benefits that we are utilizing today, right? And my job is to make sure that your policy remains under the umbrella of section 7702 of the tax code, which defines life insurance. Life insurance comes with an enormous suite of tax benefits. However, when people started pouring money into whole life insurance because of these powerful benefits, the mutual fund companies, the term providers, Ralph Nader, Ralph Nader on the consumer protection side, saying that people are getting ripped off by life insurance because they're not getting enough cash value early on, and also the companies that couldn't compete, like mutual fund companies, they lobbied Congress in the 80s to restrict these benefits. They said, hey, these people aren't trying to protect their loved ones. They're just trying to get a tax loophole. Again, it's not a tax loophole because it predates the tax code. However, that is what they said. The life insurance industry did a poor job of representing itself, and the lobbying was effective enough by mutual fund carriers, et cetera, who said we're losing out here. We're losing market share because this product is more powerful. Whole life insurance, take that, isolate that. Whole life insurance is such a powerful asset that wealthy people were pouring money into it, so much so that Congress was lobbied by financial services firms to restrict how much money can go into it because it's that powerful, and they were losing market share. Let that sink in. That is what happened in 1988 when they passed this bill called TAMRA that effectively kind of handicapped how much we can fund these policies. If we didn't have to deal with that, then the client who comes to me and says, hey, I've got $100,000, the client I'm working with right now, I got $100,000 to put into a policy. How quickly can I put it in there? Well, if it wasn't for these MEC rules, if it wasn't for this new, as of 1988, this new flavor of endowment contract, modified endowment contract, section 7702 alpha added to the tax code to differentiate. This is tax favorable life insurance. This is not tax favorable. This is a modified endowment contract. If we move our policy from the wrapper of life insurance to the wrapper of a MEC, a modified endowment contract, we lose those tax benefits. If it wasn't for that MEC status, then my client who currently wants to put $100,000 into a policy as fast as possible could just put $100,000 into a policy, in a single pay policy, buy a chunk of death benefit. She's single, no children at the moment, doesn't care about the death benefit. All she wants is, how do I use this now? she could do that. She could put it all in and get her full cash value, almost 95 cents on the dollar available immediately, which would then grow tax free, create dividends that would generate more death benefit, which generates more cash value. Like it would be awesome for her. That's exactly what she would want. However, we can't do that, and why? This is what was lobbied for, and so there was different time frames that were proposed, but the one that was settled on was an arbitrary 7-year test where effectively, if you pay for the death benefit, fully pay it up, recall that paid up means we're paying these policies up till age 95. So my whole life policies, most of our clients' whole life policies are paid up at 95. You have not fully paid for the death benefit until you make your final payment at age 95. Whether you're starting at age 20 or whether you're starting at age 60, you're still paying it up till 95 for the most part. And at that point, there's no more premium going into the policy. You paid up the policy. Well, a single pay policy is paid up in one. And if that sounds familiar, it's because it is. PUA is a single pay policy. It's that death benefit is paid up one time, right? That in our example last week, $16,000 bought us, what was it, $40,000 of death benefit in one single payment. It was effectively what CPAs were telling their clients to do in the 80s. Put money into a one-time premium payment, buy one chunk of death benefit, and now you get all these tax benefits. It's like a cheat code. It's not a cheat code. It's not, because again, it predates the tax code. However, it is effectively, as far as we have access to now, as far as financial tools go, whole life insurance is a cheat code once it's understood. Now, we can't do that today with our main policy. We can only do that in chunks on top of the chassis of the base policy in the form of PUA. So once that policy is paid up, we no longer pay into it. And so in 1988, the Tamer Act that set this in force and added Section 7702 alpha to the tax code said, if you pay up this policy in 7 years, you're funding it too fast. 1 year was way too fast for them because money just floods right in, right? The quicker you can be done with paying this thing, the more appealing it is to people that just want to put money in, forget about it, and generate a large tax value. Well, they said, they debated different lengths of years, but they settled on 7 years. If you pay this too fast, the lobbyists for the financial service firms who were selling mutual funds, et cetera, and losing market share said, you're not trying to benefit your loved ones here. You're not trying to, the reason death benefit is tax-free is because of this idea that we want to incentivize people to take care of the next generation. Well, if they're paying it that fast, they're not trying to do that. They're just trying to capture these tax benefits. Again, which speaks to how powerful the tax benefits are if it required lobbying of Congress to get them to change the IRS code to add in this new category of modified endowment contract. So we have this extremely powerful contract, so powerful that companies had to effectively take it to Congress to give them a fair shake in the market. Their products, the mutual fund industry, they couldn't stand on their own legs in the face of fair competition here. So they had to basically Tanya Harding the competition and make it so that they had a fighting chance, right? So that's 1988. That's a little bit of a quick version of the background of why we have this modified endowment contract rule. Now what I'm going to do is I'm going to go over to my whiteboard again, and I'm going to walk you through how this actually plays out. Because your question that you should answer by the end is, why can't I just do all PUA? And you already know the answer is because we would make the policy. But how does that actually translate into our planning discussion here? Why do we need? And I'm going to introduce another term or another concept here, another type of premium into this one that you'll see when we structure your policy. Now, last week, if you watched that video and knew nothing else, you would assume we have two types of premium, base and PUA, because those are the only two I talked about. In reality, to structure a policy the way that I did last week in the video, i.e. 20% base, 80% PUA, to pay that much PUA premium, we would have to add what's called a term rider. A term rider is a chunk of death benefit. It's term insurance, not a separate policy. A rider, i.e. in addition to the base policy, just like the PUA, the ability to pay PUA premium is a rider in and of itself. A term rider is a chunk of term insurance purchased on top of your policy, which serves a very specific purpose for what we're trying to do. So here we go. I'm back to our example from last week. We've got the same numbers here. This should look familiar. Again, if you haven't watched that, please go back and watch that so that this all looks familiar. But we talked about last week, we had a $20,000 annual premium at 2080. So as a refresher, that means 20% base, so $4,000 of base premium, and we have $16,000 of PUA premium for this structure. In reality, what you would see if I built you this illustration is a little bit shy of $4,000 in base and a little bit shy of $16,000 in PUA and a couple $100 worth of term premium to buy a term rider. So what are we talking about here? So all right, here's 35 to 65 to 95. We're paying 60 years of our premium here, right? You can't MEC, we call it MECing a policy, i.e. taking a policy from the life insurance wrapper to the MEC wrapper, the endowment contract wrapper. What happens when a policy becomes a MEC is that everything you do with it while you're alive is now taxable. So the MEC status 7702 alpha strips away all these tax benefits and says, no longer are your policy loans tax-free. No longer is your cash value growth tax-free if you access it. Your dividends, if you take them as cash, are not tax-free. Effectively, this now becomes as ineffective as a traditional 401k or a traditional IRA. It just becomes a taxable vehicle, right? There's the same restrictions with early access. There's 59 and a half. Like it effectively becomes a traditional IRA. So i.e. not effective at all. The death benefit in a MEC is still tax-free to your beneficiaries, but you're stripping away all of the living benefits. Not stripping them away, you're just making them a lot less powerful. So one of my primary jobs is to make sure we do not MEC your policy. When we say MEC, we mean turn it into a modified endowment contract, i.e. move it from the the 7702 life insurance wrapper with favorable tax treatment to the 7702 alpha modified endowment contract wrapper with very unfavorable tax treatment. That's one of my primary jobs, is to make sure their policy cannot become a MEC, or we don't MEC the policy. So you can't MEC a policy paid up over 60 years, because what is that test again? It's 7 years. If you pay this death benefit up in 7 years, you have MEC'd the policy. Well, if I'm paying it in 60 years, obviously I didn't MEC the policy. So with a base-only premium, you can't MEC the policy because the premium is spread out over a very long time frame that it's not possible to MEC the policy, right? So here we have our base premium paid every year till age 95, and that puts in force a specific amount of death benefit. In this case, we use an example of $350,000. Now, there are different structures for a policy. We call it a paid up at 95. This is what the majority of our clients have. But you could have a paid up at 65. So this client here could pay, put this right in the middle. This client here could pay up at 65 his premium. That's 30 years from now, because remember, this is a 35-year-old. So he could pay up at 65. And so if we think about this, it costs us $4,000 a year in base to put in $350 in death benefit over 60 years. Well, if we shave 30 years off of the payment period, what has to happen if we're going to keep the same death benefit? If we're paying 30 fewer times, what has to happen to the annual payment in order to compensate for cutting off of those years in order to keep the death benefit the same? Well, obviously they have to go up, right? So if we were to draw, and if you're watching or if you're listening, I'm drawing on this box here. We have our box of base premiums spread out all the way to age 95. Well, now we have a new box, right? We're paying more premium for 30 years because we are only paying for 30 years instead of before paying for 60 years. So we obviously pay more in a paid up at 65 than he would in a paid up at 95, right? That should be intuitive. Now let's add another one. There's a different type. Like I said, there's a few other types of premium payments. Let's do one called a 20 pay. So in that case, a 20 pay means you pay 20 years of premium. Your policy is paid up in 20 years. So for this guy, that's age 55. So here in yellow is age 55. That's a 20 pay for him. So if we have X amount of premium for paid up at 65, i.e. 30 years, if we're going to shave that 10 years off of the paying time frame to pay up the same death benefit of 350, we have to pay more. So that should be intuitive as well. So obviously the lesson here, the more years we shave off of the time frame period of paying the same amount of death benefit, the higher each of those remaining ones has to be, right? So we have a paid up at 95. We have a paid up at 65. We have a 20 pay right there. That's the age 55 for him. We also have what's called a 10 pay. You could do a 10 pay policy where you only do 10 years of premium payment. And therefore, for him, a 45 year paid up at 45, those all have to be higher than the ones before. And then if we think about, let's go back to our PUA example, we made one single PUA premium payment last week. We would have to pay the most we could pay in 1 year to get this thing paid up would be a single pay policy. So that's just one single bar here. And again, that should look like we saw last week. In this case, maybe we pay $200,000 on day one to pay up $350,000 to death benefit. And the longer we drag out that time frame of payment, the less each one needs to be for the same death benefit, right? Okay, so if this all makes sense, then we have to cram in here a hypothetical, not actually existing 7-pay premium. So how much? So that 7-pay test for the MEC test is saying how much death benefit would you how much premium paid 7 times theoretically would pay up $350,000 of death benefit. So we know it has to be more premium than the 10-pay, right? Because we're shaving 3 years off of our 10-pay premium, but less premium than the 1-pay because we have 6 additional years to pay. So somewhere in here, we have what's called the MEC line. So for this guy, if the 35-year-old paid up the same death benefit by age 42, he's paid it up in 7 years. And Congress would say, well, you're no longer, or the lobbyists would say through Congress, you're no longer trying to protect your loved ones. You're just trying to cram money in here as quick as possible so you get these tax benefits as soon as possible, right? And so now we have this line here, which if you're listening, I've got subsequent boxes that get shorter in height as we pay more years worth of premium, shorter in height because less premium is required, but longer in duration. And so we're going to isolate. I'm going to erase, here's my 10-pay, right? I'm going to erase that 10-pay. I'm going to erase the 20-pay. I'm going to erase my paid up at 65 just to isolate the one variable here that we're talking about, which is this 7-pay box. So we have what's called our MEC line here. And so again, I'm not going to try to figure out a number that even makes sense. Let's just say this MEC line is $15,000 a year. Again, don't even do the math here. Don't try to do the math because I'm just making up numbers. My number needs to be less than 20 in this example. And so we said, if we tried to do this, if we tried to pay $20,000 in 1 year and our MEC line, i.e. the point where the IRS says, if you paid X amount of dollars 7 times, you would fully pay up a $350,000 death benefit. If that number was $15,000 and we try to put $20,000 in, I'm going to draw a line here for that premium. That premium is going to break through that MEC line on the top. Once you do that, once you break the MEC line once, the policy becomes a MEC and you can't reverse that. That's an irreversible transaction. That's why it's so important that we structure this right. So here's where we stand. I'm gonna draw a 7-pay box down here, isolate it a little bit, kind of zoom in on our 7-pay premium here. So we have 7 iterations of premium where the IRS says if you were to pay this in full 7 years in a row, you would have a modified endowment contract. Okay, we were tracking that so far. And this number we said is $15,000. So what we wanted to do is we wanted to pay $20,000 of premium. So $4,000 of that would be base premium, and another $16,000 of that up here would be our PUA. So we've MEC'd this policy. We can't do that. We cannot MEC the policy. We would rather have less cash value and not MEC the policy than have a lot of cash value in a MEC. And so here you could see in this example, again, where I made up, don't try to figure out the numbers if these make sense, but if we were to pay $15,000, let's say we paid just shy of that. We paid $14,999. So we did not break the MEC line. And in doing so, that gave us about $11K of cash value, i.e. $11K of PUA premium. Well, that would be acceptable. We no longer have a MEC. We have $11,000 of PUA, and we have $4,000 of base. That got us under our MEC line. So this is actually a doable policy here. But as soon as we break that MEC line once, we now have a MEC, and we're no longer getting those tax benefits. So it's super important that we don't MEC this policy. Okay, well, how, if the MEC line is a function of the magnitude of the death benefit, i.e. for $350,000, it would take $15,000 a year times 7 to pay up that policy, again, made up numbers. If it's a function of the magnitude of the death benefit, well, we know that if we increase the death benefit, so now let's say we were going to do the same breakdown of premium structures here, but for $500,000 of death benefit, well, we know each of those would have to be higher. Because if this red box here shows how much premium we have to pay till age 95 to pay up 350, well, it should be obvious that that number each year has to go a little bit higher if we're going to pay up more death benefit. And the same thing applies to our 7-year box. So what we're doing if we add more death benefit here is we're increasing the size of that MEC box, that 7-pay box. We increase that 7-pay maximum because we increase the magnitude of the death benefit. Now the question is, how do we increase the magnitude of the death benefit while taking up as little of our allowable premium as possible? Because remember, this 15K premium limit here, that includes all type of premiums. That includes the base and the PUA. That's not just base. So how do we add a lot of death benefit for very little premium? Well, if you understand, last week we talked about the cost for term being very cheap, right? It's cheaper because it's lower in value. It has very little value in and of itself. Do you die during the policy or not? It's priced with the near statistical certainty that you're going to outlive it. If you're 35, it's super cheap. But that's a disadvantage when we're talking about long-term protection and a sound financial strategy. Buy term and invest the difference is not a sound financial strategy if you're thinking long-term and you want to actually have a cohesive, holistic strategy. But in this case, it's exactly what we need. Because what we need to do is we need to beef up that death benefit, because the magnitude of the death benefit sets the magnitude or the height of our MEC line here. So if we want to add more premium, we want to put in as little premium as possible, because this term premium doesn't get us any cash value. We want to put in as little term as possible and get as much death benefit as we need to get the MEC line where we want it to go. So in this case, what we would do is, I said we were going to squeeze a few $100s worth of PUA or of term premium here. So let's just keep it simple. Let's say we shave $200 off of the base, so we're down to 3.8. We shave $200 off of the PUA, so we're down to 15.8, and that gives us $400 worth of term premium. That $400,000 of term might get us the additional death benefit. So now we're at this $500K because we bought $150,000 of death benefit. Okay. Now what that did was that increased our MEC line to, say, $21,000 MEC line. And now we want to put 20 grand in the policy. We are cleared hot, right? Our new MEC line is 21, but we only want to put in 20. That's the role of the term rider in your policy structure. We need to put it in there to kind of not artificially, it actually does juice up the death benefit, but it's only doing so that we can pay PUA. So now if I go down here and I go back to this little visual of our 7-pay box, before that line was 15, 4 of it was base, and that 16 we paid a PUA was going to MEC the policy. So here I'll indicate, here's our $4,000 of base premium. And paying 16 grand a PUA, we don't have the luxury of doing that because we would MEC the policy. But what we did was, when we put in that additional term policy, we used a $400 sliver. So this is just a little bit of our premium allowance. We spent a little bit of our allowance here, but what we did with that little bit of allowance, that $400, was we raised our MEC line up. So now we have a new line up here. We increased the size of our box. So it took $4,000 of base and $16,000 of PUA to get us this 15K MEC line in this example. But it only took another $400 here of term to get our MEC line raised up to 21K. Again, made up numbers. So now we say, for this tiny little sliver of blue here, we now have the ability to put in our 16 grand of PUA while still remaining below the MEC line here. That is why you're going to see a term rider with your policy, not because we just want to juice up the death benefit, because we want to pay PUA. This client wants to pay $20,000 of premium. He wants to pay $16,000 of that towards the PUA rider, but he can't exactly without having a term rider in there. And so some companies will add the term on top. So this might be $20,000, $20,400. Or some companies will bake the $400 into the total 20. It's kind of up. You can do it really either way with any company. It's up to the client how if they want to pay 20 or if they're okay for paying 20 and then the 400 on top. But either way, we're going to need that $400 to buy the additional term cheaply using a small amount of our allowance of premium, our MEC allowance, use a small amount of that allowance to buy a large chunk of death benefit, bumping up that MEC line so we can fit our premium in. Now, I hope that makes sense. That answers the question, why can't we just do 100% PUA? Because let's think through, let's go back to our lesson last week. Remember, our $16,000 of PUA premium last week bought us $40,000 of death benefit. So now we're moving in the opposite direction. So if you said, hey, I just want to do $20,000, but I want to do all PUA, I don't want to pay base. Why would I pay base till I'm 95? I don't want to do that. What you're doing is you are greatly driving down the portion of premium that generates death benefit, i.e. your base, in favor of the portion that gets you very little death benefit. So here, if I go down this direction and I want to pay $20K of PUA, which might get me, we'll say $30K of death benefit. Well, now I've done the opposite. I've shrunk my MEC line so much because I have no death benefit. So I'm going to MEC this policy instantly. I can't do that. That's why I can't pay 100% PUA. And now this relationship here, when we talk to a client, I'm going to scroll up here to draw. I'm drawing a bar lying on its side, just a horizontal bar here. The question is, we want to figure out the total annual premium that we want to pay. In this case, it's 20. And then we need to put this dividing line somewhere. A 50-50 policy, that line would be in the middle. For our example, a 20-80 policy is probably right about here. 20% base, 80% PUA. That's the desired structure. We're not going to get exactly that because we need to throw some term in there. But it should make sense that the more we move the base premium down, the more we have to effectively, like we're handicapping the death benefit there, right? Because we're buying more PUA, which generates a small amount of death benefit, but we're asking for a large allowance of premium. So we're reducing our allowance of premium per the MEC line. At the same time, as we reduce our allowance, we're asking to use more of it. So it just doesn't work. So we have to supplement or artificially increase the death benefit. We have to buy ourselves some allowance with term. So the more we dial down the base, and the reason people would want to dial down the base is because they want more cash value early, i.e. they want more PUA premium. The more of your premium you allocate towards PUA, the more you need to allocate towards term to compensate you for the fact that you're not getting the same amount of death benefit, and therefore you're dialing down your MEC allowance. You need to bring that allowance back up using term. Now, someone who wants a 50-50 policy, I have a client who only does 50-50 policies. If you do a 50-50 policy, you're saying, I want a huge MEC allowance, and I'm only going to eat up a little bit of that allowance with PUA, or half of it, right? And so you don't even need a term rider for most companies for a 50-50 structure policy. You don't need a term rider because your base is sufficient to give you all the allowance you need to put in half of that premium. So in this case, you could do $10,000 of base premium, which would get you a large death benefit and a large MEC allowance sufficient such that you can put in $10,000 of PUA without getting anywhere near your MEC line. The lower we dial down the MEC line, the lower we dial down our base premium, the more PUA we pay, therefore the more cash value we have early, but the more term we need to supplement because we're handicapping our ability to pay PUA by the fact that we're adding more PUA. It's a little counterintuitive there. I hope that all makes sense. And if it does, I am going to stop this share here and move to an illustration that walks through a policy. So we're going to put all of this together here. Now I'm going to share an illustration that I built for a hypothetical client. His name is Jinx McCashvalue. He loves whole life insurance. He loves cash value. And he comes to us and he says, I love IBC. I really do love it. I, Jinx, love IBC. But I don't really want death benefit. All I really care about death benefit for is for burial expenses, right? I'm not married. Don't have children. Yeah, sure, I'll leave something to relatives, whatever. But really, I just want the people who are going to bury me to get a little bit of death benefit to take care of that. That's all I need whole life insurance for. But I do love that. I understand and appreciate the tax value of life insurance. I really want a lot of cash value, but I don't want the death benefit. So get me as much death benefit as I can, as much cash value as I can, and do this as efficiently as possible. So that's what we're going to do. So now I'm on the life insurance for Jinx McCashvalue. Okay, so Jinx says, I want to pay 20 grand and I want to do it at a 20-80 split. That's what this is. But it has a term rider. As we discussed, we need that term rider. So a few things here. This illustration is a 24-page document. This is not the contract. This is a visualization tool. If you are seeing an agent, they need to give you the entire illustration. If they're only giving you a screenshot of it and not attaching the whole thing for you to review, they are not in compliance with insurance law. So call them out on that. Do not do business with someone who's just send you illustration after illustration right away without walking you through all of this. Like, now I believe if you've watched this one and our prior episode, I believe you have enough knowledge to understand what you're looking at. And I would feel comfortable after these 2 calls sending a client an illustration for them to look through after we go through this, so you know what you're looking at. But if someone's like, if you just say to an agent, hey, I want an IBC policy, and they just send you an illustration, or worse, they send you a screenshot of 1 or 2 pages, run away and talk to us, because we will not do that. We're not going to send you an illustration until we know that you should understand what you're looking at. So this is a visualization tool. We're going to see the premium breakdown here. There's also a lot of just contractual verbiage. Sorry, not contract. This is not a contract, but a lot of just like description of things and definitions. But then there's what's called a tabular view, which is a growth chart, or it looks like just a wall of numbers, but it'll make sense when we go through it. So I'm going to skip down here, not because this isn't important, but a lot of this is definitions and terms of different riders that are included here. But I'm going to skip through this, and I'm going to go down to the premium breakdown page where we'll see some of these elements that we talked about. We've got our premium breakdown here, and you can see we have $4,000 of base, we have $238 of term, and $15.7 of PUA, which gets us to our $20,000 annual premium, right? Now, here's something interesting, and again, I'm totally making up numbers on my last one. So you can see here, this base premium is actually only $150K, so it's less than I was saying. Now, each company is going to have effectively, think of it as a sliding scale from guaranteed to non-guaranteed side. Now, this company in particular, Lafayette, is very heavily on the non-guaranteed side, i.e. dividends, right? Dividends are not guaranteed. We don't know what they're going to be. But these illustrations, this product in particular, their Whole Life 95 product, is very dividend heavy and very light on the guarantees. So this is a product that effectively requires dividends to perform as illustrated. The more a company scales towards the guaranteed side, the lower their dividends are, but the higher their guarantees are. And we work with 2 companies primarily that are on opposite ends of this scale. One of them has very high guarantees, so the same amount of premium here, $4,000 of base premium, might get more than double this in death benefit, right? However, they would be very low on the dividend scale. Conversely, this company dials down the guaranteed side and increases the dividends. And so for a client like Jinx Mixed Cash Value, who loves life insurance but really just wants it for the cash value and the benefits now, this would be the perfect tool to use, because we don't really care about the fact that the dividend, the death benefit is low, because we know we're going to be getting large dividends to compensate. There's no deals in life insurance. Effectively, think of it as a fixed pie. A company gets to allocate towards the guaranteed or non-guaranteed side, how they choose. And so in this case, they've allocated a lot more towards the dividends, which we'll see above. So I'm going to scroll up here. And this is the tabular view breakdown. So what we can see a couple things here. We can see the guaranteed side here of the ledger on the left side, and then the non-guaranteed side. Now there's one difference in how these are and what these 2 screens show, but there's 3 assumptions that are baked in, and we'll go through those. So the first thing that's different here is the annual dividend right here, this column. The guaranteed side over here shows as if there is never a dividend paid again in the future of this company. The non-guaranteed side assumes a dividend. But how do we assume a dividend? We don't know what the future is. The future is unknown. The company's profits are unknown. And so that's an unknown value there. However, we do mitigate that by using a company like Lafayette, which is 23 years old now, and has paid a dividend every one of those years. So we don't know what the dividend will be next year, but we have very high certainty that there will be a dividend, because unless it's the first in 123 years, they survived the Great Depression with profit. They survived the COVID hoax with profit. They survived World War II, the Great Financial Crisis, and paid a dividend through all of that. So we have very high reasons to believe they will pay a dividend next year and the next year and the next year. What that dividend number is specifically, we don't know. So how do we assume? 100%, you can see up here, 100% of the current dividend scale. So they're going to look at, this is April 2026, they're going to look at the last dividend declaration they made at the end of last year and say, if that number were to hold for the future of this contract, this is what, if you made these payments, this is what those dividends would be. So that should tell you right off the bat, these numbers are not worth the paper they're printed on, because this is not what's going to happen. This is I would say, like if you look at like a standard deviation, this is within a standard deviation of what will very likely happen statistically if we look backwards and apply that to the future. But again, this is unknown. But we want to see if the dividend, if the company's performance continues as it has over the last year, and they continue to pay dividends as they have for 123 years, then this is what this policy would look like. So again, this is a visualization tool. This is not predicting the future. Like we are very clear, this dividend is an unknown entity. We don't know what this number is going to be, but we have very high confidence that there will be a number here. On the guaranteed side, this is the floor. If the company never pays a dividend in its future ever again, this is the guaranteed minimum. However, when a dividend is paid, in this case, $12.60 in year one, they make that dividend payment of $12.60. I use that optional to purchase death benefit, which increases my cash value. Now that moves over to the guaranteed side. Once it's actually declared, the dividend is actually declared, and then is used to put back in the policy in the form of purchasing a PUA, then it becomes part of the guaranteed. And now this entire floor on this side moves up accordingly, right? Does that make sense? We increase this floor every time we take a dividend, we earn it, we use it to purchase PUA, we increase our cash value, and now every number after this on the guaranteed side increases. But again, if starting on day zero, we never have another dime of profit from the company again, this is what this left side is what we would be focusing on. However, we are assuming that's not going to be the case, and therefore we're going to spend our time anchored on the non-guaranteed side over here, where we do presume a dividend. Now, I said there's three assumptions that are made here. The first assumption that's made is that the dividend is the same as it was last year, which we know it won't be, but something like this is likely to occur. The second assumption is made that we actually pay the PUA premium. Remember, we don't have to pay the PUA premium. We have to pay the base premium. We have to pay the 4, but we don't have to pay the 16. In this illustration, I told the software, assume that we pay 20 grand a year for 30 years. So this guy is paying 20 grand a year until he's age 65 for 30 years. He doesn't have to do that. We want to do that. Ideally, that's optimal. This is the best savings vehicle we have. And if you can see the growth of the policy, it's enormous if we continue to do this. But again, that's an assumption made that we're paying 20 grand a year. The third assumption that's made is that if you look up here, you see dividend option, PUA. We have different things we could do with this dividend. We could take that dividend and get a check with it. The company will send us a check for that dividend, and that amount is tax-free up to our cost basis, like I discussed earlier. You could take your dividend and use it to purchase your base premium. So you could say, hey, take this $10,000 dividend and use $4,000 of it to pay my base. But what's optimal here, and what we want to do if we're talking about IBC, is that we want to take that dividend, purchase more death benefit. That death benefit generates cash value immediately, going back to our last lesson. And now that increase in cash value increases the size of our policy, obviously. And our dividend is our pro rata share of the company's performance. And so therefore, as we grow our policy, we grow our dividends correspondingly. So every time we do that, if we continue to do that, if the dividend goes from here, the dividend's declared, they say you get $1,260. We say, okay, purchase however much death benefit that will in the form of the PUA. We buy more PUA death benefit, which generates more cash value. And now, because we've increased our policy, our dividend the next year is larger. You can see here in year 2, it's just shy of $2,000. We take that $2,000, we purchase more PUA death benefit, which increases our cash value by about $2,000, and then we have a larger dividend the next year. Those three assumptions, that we pay the full premium, that we use our dividend to purchase purchase PUA death benefit, and that we get a dividend on this scale, those are the three assumptions made. So again, this is a visualization tool to help kind of put meat on the bones and understand what we're looking at here. Now, a couple numbers that people like to look at. On this one, you could see this is a very effective policy. Within 3 years, Jinx here puts in $20,000 and generates over $20,000 in cash value. Now, if this is your savings vehicle, that's a very quick way to get a effect. All right, let me go back. We view starting a policy as starting a business. And what do I mean by that? Well, if we have guaranteed fixed expenses and guaranteed profitability, it's just a matter of how soon do we get to profitability. In this case, it's 3 years. I put in $20,000 into my savings vehicle, and I generate more than $20,000 only 3 years in. Now, if we think about the normal base policy, and what people really hate about whole life insurance is they're thinking about that normal base policy. How long does it take to put in, say, $4,000 of base premium and get $4,000 of cash value growth? It might take 15 years. It might take 20 years, depending on how the company structures it. But base premium generates cash value a lot slower than PUA does. By using PUA, we bring that period so close to the present that we generate this guaranteed profitability in the business in short order. In this case, a 20/80 structure within 3 years. I put in my 20, I have more than 20 in cash value growth that year. Let's take another year. Let's take year, here we go, year 17. I put in 20, I get more than double that in cash value growth. I get 41.7K in cash value growth that year. Now, why? Well, because one, my dividend that year was $16,000. 16. And why is it $16,000? Because every time I take a dividend and use it to purchase more death benefit, I increase the size of my policy, which increases the size of my dividend. So here we can see by year 5, our dividend is larger than our base premium. Our dividend is $4,300. Our base premium is $4,000. At this point, you could take your dividend and tell the company, instead of purchasing more death benefit in the form of the PUA rider, take my dividend and apply it towards my base premium. And now your policy is effectively paying for itself. Any dollars on top of that you want to throw into the policy in the form of the PUA rider would go straight to cash value, building that savings vehicle. But you can see here, if you were to do that, remember the reason these dividends get so large, the reason why within 5 years your dividend is larger than your base premium, the reason why in here we go, like 20 years, your dividend is larger than your entire premium just in the dividend. Remember, when that's tax-free, your dividend alone is larger than your entire premium in 20 years. The reason is because we're continuing to cycle that back into the policy. If you truncate that, if you chop off that growth early at 5 years, well, you'll likely keep getting dividends large enough to pay your base premium. They're just not going to get the same amount of growth as you see here, right? So this shows, again, the assumption that you continue to take that dividend and apply it into the policy. Those are not things you have to do. You are the banker. You are in charge of this policy, so you can tell the company what to do with the dividend if you don't want to purchase PUA. This shows if you did purchase PUA. Another metric we can see here is by year 5, we're at $98,000 in total cash value on $100,000 of premium paid. So you might say, hey, I'm underwater here. What gives? Well, we're starting a business that's guaranteed to be profitable, and it takes a little time to get that business off the ground. But look what's happened. We put $100K in here, and if we die, we're leaving our wife 5x that amount tax-free. So that is the other benefit here beyond just this cash value column. And if you remember from the policy loan walkthrough we did a couple weeks ago with Joe Withrow, and I talked about what I'm specifically doing with my policy. I've used it as the down payment on 3 rental properties. I've used it to fund an investment in a real estate syndicate. I've used it to trade options in my low stress options trading account. I've got 5 sources of income generated from my cash value. None of that's shown on my illustration. This is just the internal growth metrics of the policy itself, but it doesn't show you what you can do with the cash value in growing this policy. And so by year 6 here, I've got more in cash value than I've put into this policy, and that delta only continues to grow. Right? By year 10, I've got $232 in cash value, and I put in $200,000 of premium. Again, not an investment return, a savings return here. My favorite metric to look at personally is the year-over-year growth, because I view this. Let's say, let's say I put in $20,000 and I get, 21.5 here, as you can see in year 4. Well, if I take that and put that into the calculator, 21,487 times 5. I'm at 107 annualized, right? Or sorry, I'm just trying to do this on a base 100 here. So that's effectively a 7.4% return, right? If I put in 21,000 if I put in 20 and I make 21.5, I've made about $1,500 on my 20. That's a 7.4% return in my savings vehicle, right? So I get my savings account balance. Again, this is not precise terminology. But if I view this as my savings vehicle, I like to look at when I deposit $1 into my savings, what is my rate on that? You could think of this as a 7.4% high yield savings account. And I've got that by year 4. What happens if I do, if 37, so in year 15 here, I got a 37,889, right? And I times that, like I'm at an 89% savings rate right there. At a certain point, I'm getting more than twice what I'm putting in. Later down the road here, I paid PUA for 20 years, 20 grand in at year 30. I'm 65. $20,000 in generates $76,000 of cash value, right? That's close to a 300% rate of return. I've grown my total cash value to $1.25 million on a $2 million death benefit. I'll fast forward to the end here at age 121, Jinx MEC cash value. You can see at age 121, $13 million in death benefit is exactly equal to $13 million in cash value. Because going back to last week's episode, the present is now the future. That's when this death benefit pays out. So your cash value is going to be paid to you in the form of the death benefit, which at age 121 is when it endows. And so Jinx MEC cash value would get the 13 million in cash value here himself, not the death benefit, right? But any time before that, when he passes, it's going to be paid to the beneficiary. You can see we're over $10 million in death benefit here. Honestly, like, we're creating estate tax problems for people, which is a good problem to have, right? You can see this is paid up at 95. So at age 96, $0 are paid in, a dividend of 177,000, and an annual increase that year of 195,000. For a while there, for a stretch of, from when the policy is no longer accepting PUA premium. So for 20 years here, all we're doing is paying base premium. Let's just take age 76 here. $4,000 in, $101,000 out. Again, $4,000 in, 101 of cash value growth that year. People say, why would I want to keep paying all the way till I'm 95? I don't want to keep paying $4,000 a year till I'm 95. When can I turn this thing off? I'd say, well, at what, let's go back here. We're paying 20 a year. If I knock on your door and say, hey, I need a check for 20 grand today, but on the spot, I'm going to give you a check for 38. Would you come up with 20 grand on the spot? Yes, of course you would. And if I said, hey, I'll be, and I'm on year 15 here if you're looking at the screen. I say, hey, I'll be back next year for your 16th payment of 20 grand. And at that point, I'll be back. You give me your check for 20 grand, but next year I'll have a check for 39.7 for you, right? At what point do you want to turn this off? You're earning dividends larger than your entire premium payment by this point. At year 20, at what point do you want to turn this off? At what point do you want me to stop coming back when every year the offer is going to be higher and higher? You never want to turn this off. So at what point do you want to stop paying premium? That's why I love paying premium. I don't view it as an expense. I view it as capitalizing my system. If I'm Jinx MEC cash value here, I want to pay premium for as long as I possibly can. I'm going to be sad the day I have to stop paying this premium because look at what I'm getting for versus what I'm putting in. You can see here at a certain point, my dividends are larger than my entire premium outlay. I've earned at this point, with this example, $747,000 a dividend. I paid $683,000 in total premium. Now, people like Dave Ramsey, who intentionally misrepresent and lie about this, would say, oh, dividends just a return of premium. That's why you guys talk about dividends like it's great. It's just a return of premium. That just means you overpaid your premium, so they're going to give you some back. Oh, whoop-de-doo. This whole thing is a scam. Okay, David, explain how I can get more in dividends total than I put into the policy total. If it's just a return of premium, I mean, that's technically what the IRS classifies it at. And that's a great thing for us because that means it's tax-free. We're not taxed on those. So at a certain point, Jinx MEC's cash value here could kick it up. He's a pilot. Let's say he retires from the airlines at age 65. He could start taking this dividend, $40,000 at this point, dividend alone, and take that as a tax-free check, supplementing everything else he's got, right? That's an amazing feature. I love that the IRS determines that dividends are a return of premium. And people like Dave Ramsey who don't understand, or no, sorry, again, they do understand this, they misrepresent it and lie, would say that, well, that's just because they overcharged you and therefore they're just going to give you a little bit back because you paid way more than you should have, right? So just buy term instead. Well, you cannot explain this. That does not explain the fact that at a certain point I will earn more in dividends in this policy than I've paid in total premium. That just belies a total misunderstanding or an intentional misrepresentation. I'm going to wrap it up here because this is about the point where we can really start getting into some mechanics. We can really start diving into these numbers. But take a look. If you've never seen a whole life illustration structured for IBC before, I hope this opens your eyes a little bit to how powerful this actually is. This is not just paying premium, funding an expense to get some death benefit. Like, we are building a monster of a machine here. And when we're so passionate about whole life, which sounds really strange to most people who've been indoctrinated by the marketing of the financial checkers grandmaster Dave Ramsey and the money market, or sorry, the mutual fund industry, etc., this is a terrible place to put your money. Well, if you view this as your savings vehicle, if you view this as I put dollars in and I get more dollars out in guaranteed tax-free growth cash value that I can then access and leverage the policy loan, etc., if that's the case, take all of my money, right? That's why we love. That's why I have clients that pay over $200,000 a year in premium. A lot of our clients, I'd say the average is like $30,000 a year in premium. That sounds absurd if you don't understand this, but when you understand how powerful this gets, how quick it gets powerful, you want to put in as much as you can and you don't view it as an expense. That is my overview of what the MEC line is, why we need term, why you will see a term rider with your policy if you want to pay a high PUA, a little bit of a background on like kind of the history of the MEC and why it came about, and then illustration 101. If that put some light bulbs on in your head and made you think like maybe I should reconsider this, hop on our calendar. Links below. We've got remnantfinance.com/calendar, and then we've also got a whole learning center with a blog. We've got the podcast, obviously. We've got a reading list, and then we're working on some cool stuff in our client portal. But we would love to chat with you. I'd love to walk through and have the same conversations with you. But hopefully, if you come to the table having listened to this one and the prior one, you come to the table with a much stronger foundation of knowledge, which is great because then we can get more in depth on your specific illustration and talk about things specific to you. We're going to do this right. We're going to make sure you understand this. We're going to make sure it's structured in a way that it cannot MEC. We want you to think long-term, not just immediate cash value, but to the degree that you do want that immediate cash value, we're going to do so in a safe manner. That's my talk. That's wrapping up this IBC, masterclass or whatever you want to call it. And as I say that, I think I might actually do one more walking through policy loans again. And we'll take this illustration and put it side by side with policy loan, how we use it a little bit more. So maybe we'll do a part 3. But we've got some exciting interviews coming up. I'm really stoked on the next couple of weeks of podcasts. Going to introduce some very cool interviewees and some cool concepts here. But we'll see you guys next week. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.